In this video, I will be going over AT&T Spin Off, 2 stocks I'm buying right now, and as usual, a portfolio update. Earlier this week, the management from AT&T provided us more information on the Warner Media spin-off, which includes the adjustment on the dividends and the Warner Media shares. In 2021, the management from AT&T wanted to focus more on the core of the business, which was telecommunications. By doing that, they had to sell assets that obstruct them from that goal. They announced that sometime in 2022, AT&T will do a spin-off from Warner Media, which is being merged with Discovery. Well, we got more info. The transaction, which will spin off 100% of AT&T's interest in Warner Media to AT&T's existing shareholders in a pro rata distribution, followed by the merger of Warner Media with Discovery, is expected to close in the second quarter of 2022. Additionally, the expected annual dividend after the spin-off will be $1.11. This is down from $2.08. Given a dividend payout of 40%, this is also down from the current 61%. As previously disclosed, this transaction will be structured as a reversed Morris Trust, which is a tax-free event. AT&T will receive $43 billion in combination of cash and other considerations, while shareholders will receive 71% of WBD, which is the ticker for the new company for Warner Media and Discovery. The amount of shares estimated to be received by AT&T shareholders is 0.24 per share of AT&T. As the transaction date gets closer, this number can vary and is determined by the amount of AT&T and Discovery shares outstanding. Keep in mind that receiving these shares will be tax-free, and as a shareholder, no action is required on your end. WBD shares will appear in your portfolio. Now, my opinion on AT&T is that by completing this merger and focusing on the core business, it could provide long-term value to existing or new shareholders. I do have in mind that there's better companies outside of telecommunications who could provide more value to the money that I'm investing in AT&T. Right now, my investing horizon is long-term, so having a cheap value company focusing on their core business, paying down their debt, and an attractive yield with a low payout which gives room for extra growth, I will say that I will be buying more AT&T in the future. Moving forward, let's talk about 2 companies that I am buying today, StarBucks and Clorox. Both of them reported earnings and the results were somewhat not so good. Let's start with Starbucks. They reported an earning per share miss of 9 cents with a revenue increase of 21.4% year over year. The stock on the 1-month chart is down almost 17%. But when we look at a bigger horizon, the stock has been trending down since summer of last year. This is due to inflation, less international flights, and pandemic restrictions where other Starbucks stores are outside the US. For example, in China, where the government is very strict with lockdown. Going back to the earnings picture, there's something that I want to point out. Starbucks Rewards membership is up 21% year over year in the US. The reward program is an app where you can purchase goods or gift cards. You can scan the product and pay separately, or you can preload the app with money and purchase directly from the app. Now, you may notice that doing the first option only rewards you with 1 star, but the second option rewards you with 2 stars. Why is that? It's because when you put money into the app, it turns into a credit and it's a way for Starbucks to have access to funds that you deposit and use it for investments at a 0% interest rate. All of this happens in the background and it does not mean that your funds will be reduced or affected. Over the long term, I trust the core business and management of Starbucks. They've had risen from previous economic situations and I believe that this is just another hurdle for potential growth. Heading over to Clorox, before the latest earnings reports, Clorox has been losing share price value due to people losing the fear of the pandemic, less use of disinfectants, and the stock hype that it was caused by the amount of investors buying during the pandemic. This made the stock to be overvalued at a certain point and now is returning way under its fair value. Clorox has dropped a little over 40% from their pandemic highs, and it seems to keep dropping thanks to the latest earnings. Let's take a look. Now, keep in mind that this is being compared to the previous second quarter of 2021, where Clorox was nearly its all-time high. Net sales declined by 8%, gross margin decreased by 12%, diluted EPS decreased by 72%, adjusted EPS declined by 67%, and year-to-date net cash declined by 65%. Clorox has been affected by inflation, and the management provided us this message. In the face of a challenging cost environment, we're executing well on the factors we control. We're driving cost savings and pricing to mitigate inflationary headwinds, while also continuing to meet strong demand across our portfolio. And we're keeping an eye on the long term by investing in innovation, our brands, and strategic digital capabilities. Although we expect cost pressures will continue through fiscal year 2022, we are confident we have the right strategic and are taking the right actions to strengthen our competitive position, build a stronger and more resilient company, and create long-term shareholder value. This is a sign of a management that is aware of the situation, and in my opinion, this positions Clorox stock in a good valuation and will continue to build my position here as well. Let's go to my portfolio, where I invest $100 every single week. Portfolio value sitting at $4,601.87 with a dividend yield of 3.52%, 16 holdings, and receiving $154.36 in annual dividends. This week I bought shares of 3M, Starbucks, and Clorox. All three are looking at a cheap valuation, and I'm planning to buy more next week. Looking at the allocation, we still have Apple, Realty Income, and AT&T holding a high percentage, but week after week it's balancing itself slowly. I will continue to dollar cost average in my core holdings and also peeking around my watch list to see if I find a value stock to start a position in. Other than that, I will remain consistent with the distributions and reinvesting the dividends. Wrapping up, that will be the end of the video. Enjoy your weekend and see you on the next one.